the biggest to track now will be RBI's monetary policy meet, and RBI is the decision will come out tomorrow in the morning at somewhere around 10 a.m. We'll bring you the latest on that. But the general consensus is that it will be continuity. The RBI is expected to maintain status quo for the 5th consecutive time. But Amit, there is an outside chance, however small it may be, that in fact RBI may go for a surprise cut. And as we know, a lot of these sectors are so rate sensitive that they'll be affected both on the upside and the downside, isn't it?
They will be, I suspect, tempted for a rate cut. They have had 4 bi-monthlies since the last increase, that was in February 23, when they increased the rates, repo rates by 6.5%. But after that, they have maintained, they have not increased for 4 consecutive bi-monthly monetary policy committee meetings. So while most investors or analysts would be looking at them not maintaining a status quo, some would be tempted towards the thought that RBI may just reduce repo rates to give more liquidity into the markets, and basically further give a fillip to the markets and the industrial scenario in general. I will explain further, if you allow me,
please,
with the help of graphics. Now, what is, if we can play the first graphic, what the sectors that are most sensitive to the repo rate price cuts are these, they are called also interest sensitive stocks.
Right.
Okay. And they are basically the stocks where in industries where there's a lot of leverage. So industries where there's a high cost of raw materials, where there's lots of borrowing in the market, be it real estate, be it auto, banking, of course, will be interest sensitive, and of course telecommunications. So these are the 4 sectors broadly which are interest sensitive. What happens to these sectors when interest rates go up?
Right.
That is the first scenario. If they can play it up, when interest rates go, this is okay. Scenario 2, when interest rates go down, the price of money basically goes down. Also, money becomes cheaper for borrowing. Liquidity increases. Investor confidence goes up. Investors' expectations on rates of returns goes down because they are expecting the markets to do well. Present value of future earnings of stocks also goes up. Stock prices go up because there's more liquidity.
Right.
Hence, market capitalization goes up. Hence, valuations go up. Scenario 1 is when interest rates are hiked. The price of money goes up. Liquidity goes down, of course. People are investing more into bank and government bonds and all that, and taking money away from the market. Right. Investor expectations on rates of returns are high. Now investors now are expecting more because they are cautious of putting their money in the stock markets.
Right.
Present value of future stock prices goes down. Price of stocks go down because liquidity reduces. Market capitalization goes down, and valuations of companies goes down. Now, if we can look at how the sensitive stocks, interest sensitive stocks, have done in the last 1 year.
Yeah, let's move on to that. If you could play
that graphic.
Starting real estate.
Real estate, auto, banking, realty, that is
right. So
telecommunications are not small,
that are rate sensitive.
Rate sensitive. Realty, in the last 5 days, in anticipation of the gains have been 4.56%. In the last 1 month, they have been much more, 13.91%. Last 1 year, of course, almost close to 60%. Realty has done well.
Best performing sector, in fact, of 2023.
Unexpectedly, because they had been floundering for quite some time in the past. The next sector, if we can put that up, banks, of course, 4.87% in the last 5 days, 1 month, 7.8%, 0.8%. and 1 year 8.67%. It is a performing sector, but it has been on a high.
I mean, it was a laggard for the majority of the
Majority
year,
of the
but
time.
in the last 5-6 sessions, we are seeing a good bit of a breakout where the
And
index has rallied.
we've been talking about it.
Exactly, 2,000 points in a matter of 2 days.
2
Amit.
days. Auto.
Right.
This sector has done well at least over the last 1 year. Last 5 days in anticipation, the gains have been 1.64%. 1 month, 10.19%. 1 year, 38.21% in the auto sector. And this is expected to grow even further in the times to come. Thank you.
All right. Now, the Reserve Bank of India, as I mentioned, the monetary policy is expected to hold interest rates steady for the 5th consecutive time. This is on the back of a expectation of inflation further easing in the months to come, and the economic data that's coming out is also stronger than expected. So there is a case for RBI to maintain rates as of now, but we also have FOMC meet that will be that the market will be taking cues from next week. US Federal Reserve December policy decision will come out next week on December 12th.